We are 7 days into the trading month, the fourth quarter, and we want to check in with Abigail Doolittle for charting futures because it's early in fourth quarter, but we've already seen some pretty big moves.
You're right about that, Scarlett. Over those last 7 trading sessions that you're talking about, right now we're looking about 1% moves up or down for the S&P 500. So what this is mapping out for relative to futures, this is 2 weeks, so it's not the true month of October, but it looks a little bit bearish. Take a look at the S&P 500 futures over the last 2 weeks or 10 trading sessions, down 2.1%. Crude oil, another risk asset, losing even more, down 6.6%. This, of course, on uncertainty around the trade war. We see investors going into 2 different haven assets, the 10-year bond futures up 1% over that time period, and then the yen future up just slightly, but nonetheless a little bit of a bid for those haven assets. That's been the story over the last few months, in fact. In the third quarter, in the month of July, ahead of the Fed's July 31st meeting when they cut rates for the first time since the financial crisis, we see that most assets had been trading higher. But on that decision, gold popped higher, that haven asset. We also see treasuries popped higher in white. Those are treasury futures, not to be confused with the yield. And then in orange and blue, we have the S&P 500 E-mini futures and the NASDAQ 100 E-mini futures basically trading lower. In fact, the NASDAQ put in its first down month of the year, down quarter of the year, I should say, in that third quarter. And we seem to be tracking that way in this fourth quarter, too. So a little bit of a risk-off tone. Nonetheless, stocks very close to all-time highs. To speak more about this, I'd like to bring in Steve Suttmeier of Bank of America Merrill Lynch. Great to have you here, as always, Steve. And what do you think about that message? At best, investors seem to be a little bit cautious on the sidelines.
They're not just a little bit cautious. They're extremely cautious.
Extremely cautious. Maybe that's bullish from a contrarian standpoint.
I think it may be. If you look at sentiment indicators, we've been tracking the good old-fashioned Bob Farrell sentiment indicator. Investors have gotten more bearish all year long. And also seasonality. Think about it. This is the worst 3-month period of the year, August, September, October. So the good news is, it's a trick right now, but seasonality suggests a treat starting in November when you move into the best 3-month and 6-month period of the year.
So let's take a look at your chart of the S&P 500 E-mini futures, which you would recommend buying. But before we do, or as we do, is the big risk-off factor more the Fed or trade or some combo?
It's a combination of everything. It's macro risk, it's China trade war, it's political risk, and it's just the way things are broadcast.
And that's certainly shown in that range of uncertainty. Neither the bulls nor the bears know.
Yes, look, uncertainty is always here, but I would argue that there's more uncertainty now than in past periods. But what we're looking at in this chart right here is really we're still in an uptrend. How do we define that? A rising 200-day moving average. I respect markets that can hold a rising 200-day moving average, and we've done it a few times this year already. And I think if we continue to do that, I think the market is a buy. I think we can complete this triangle pattern. Remember, most people talk about sell in May and go away. You never hear anybody say buy in October and stay ahead of these bullish periods. So if we can hold that 2850, 2840 level, I think we should be able to break out above that 3,000 range, trend up at 3,100. And if we really get a good rally, when seasonality kicks in more bullishly, there's upside potential to 3,200 if we meet the objective of that triangle.
Okay, so long as that 200-day moving average holds, you are bullish, then you recommend buying the E-mini futures.
Exactly.
And then you also have another interesting indicator that you presented for us before, which is the high yield credit spreads, that you're using that as another tell in terms of wanting to go ahead and buy.
Yes, this chart is basically just saying that we need to pay attention to the credit markets. Like we always show these charts, and most of the time they're confirming. And right here, right now, I will say this is the bifurcated message, but the clear message is as long as we're below this resistance on the option-adjusted spread for high yield, and it comes around 440, 444, I think we're safe and we're going to hold those levels of support and move higher on the market. If we don't, this would be a risk-off signal to focus on, where if you go above that level, it would rhyme with that 2015 timeframe where you saw spreads a bit higher in 15 than 14. We have a similar setup here, so we have to keep an eye on this. So that's the story. So I just want to present a balanced view here. Still bullish S&P, but there are a few things we're paying attention to that could change the view.